India's central bank, the Reserve Bank of India, recently decided to keep its benchmark interest rate unchanged. This was the 11th time that the rate had been kept static and turned out to be Governor Shaktikanta Das's final move at the helm. But the question remains, as other major central banks embark on easing cycles, what is keeping the RBI from cutting rates? The answer lies in managing the complex balance between inflation and growth. The last reported inflation figure in India spiked to a 14-month high at 6.2%, which is above the RBI's inflation tolerance band of between 2 to 6%. There are also worries about food prices rising in the country. At the same time, growth in the July to September quarter slumped to 5.4%, well below analyst expectations, supporting growing calls of a rate cut in the December policy meeting. But that didn't happen. The RBI governor at the time, Shaktikanta Das, said that the central bank's main mandate is to ensure price stability. Persistently high inflation reduces the disposable income of consumers and dents private consumption, he said, which negatively then impacts the real GDP growth number. It is because of this slack in the economy that the RBI downgraded its growth forecast for the current financial year from 7.2% to 6.6%. However, due to seasonal factors like heavy monsoons that impacted Q2 productivity, the RBI stated it believed that growth slowdown has bottomed out. And going forward into the second half of this financial year and the next year, the central bank assessed the growth outlook to be resilient, but warranting close monitoring. Now the focus shifts to the RBI's next policy meeting in February, chaired by newly appointed Governor Sanjay Malhotra. It is expected that there will be greater clarity on the inflation growth dynamics, domestic fiscal policy, and Trump's tariff regime by then. All factors that could lead to the RBI finally easing rates.